Click the bell icon to get latest videos from Ekeeda.
Hello friends, today we are going to learn concept of profit reconciliation statement. You must have prepared bank reconciliation statement in the past. This is similar to that. Let us see what is profit reconciliation statement. Profit reconciliation statement. What do you mean by reconciliation? Reconciliation means when there is a difference between the two values, we try to find out the reason for the difference in two values, which is called as reconciliation. Here reconciliation is between profit as per financial book and profit as per cost book. These are two separate branches of accounts, financial accounting and cost accounting. Both are based on different subject matter, both are based on different principle, different techniques, but both are equally important in the world of accounting. We use financial accounting and we prepare profit and loss account, income statement to find out the amount of profit or loss for a particular period. Similarly, in cost accounting, we estimate cost and we try to find out profit or loss for a particular period. In case of particularly manufacturing organization, we are required to compare profit as per financial accounting and profit as per cost accounting. If there is difference between these two, which is very obvious, such difference is required to be reconciled, and a statement is required to be prepared called as profit reconciliation statement and has to be filed with the central government, because government will require to find out the difference between these two profit figures shown by different set of books. Now, what are the reasons for difference in profit as per financial book and as per cost book, that we are required to understand. In financial accounting, we use different methods to find profit in relation to cost accounting. Therefore, the difference in profit arises. For example, method of depreciation. In case of financial accounting, say for example, we have used fixed installment method, that is straight line method of depreciation. In cost accounting, we have used written down value method of depreciation or reducing balance method of depreciation. Now, depreciation as per financial book and depreciation as per cost book will not be same, and that will give rise to difference in profit as per both the books. Method of valuation of stock. In business, we come across three types of stocks. Stock of raw material, stock of work in progress, and stock of finished goods. Now, these stocks are valued as per different methods. For example, in financial accounting, we have valued stock as per FIFO method, first in, first out. Whereas in case of financial cost accounting, we have used the method weighted average cost. Now, due to difference in method of stock valuation, there will be difference in amount of stock, opening stock as well as closing stock. Opening stock have effect of expense, closing stock have effect of income. Due to difference in opening stock, there will be difference in expense in both books of accounts. Due to difference in closing stock, there will be different effect of income in both the books of accounts. So different method of valuation of stock results into difference in profit as per financial book and cost book. Certain incomes are recorded only in financial book. For example, dividend received, interest received, profit on sale of assets, profit on sale of investments. These incomes are not recorded in cost book. By recording these books in financial book, profit of financial book goes up and profit of cost book goes down because of this difference. Certain losses are recorded in financial book only. Loss on sale of assets, loss on sale of investments, these are not recorded in cost book. As these losses are recorded only in financial book, profit of financial book goes down and profit of cost book goes up. Return of items are recorded only in financial book and not recorded in cost book. Goodwill written off, preliminary expenses written off, bad debts written off, these are not recorded in cost book. These are recorded only in financial book. By recording these items in financial book, profit of financial book goes down and profit of cost book goes up. As far as bad debts are considered, if we assume them as selling overheads, then they are recorded in cost book. Otherwise, they are not recorded in cost book. Transfer to reserves items, that is nothing but appropriation of profit. For example, transfer to sinking fund, transfer to general reserve, transfer to debenture redemption fund, etc. These are recorded only in financial book. In cost book, these items are not recorded. Therefore, final profit as per financial book goes down and as per cost book remains up. Continue. Items of provision like provision for tax, provision for dividend, these provision items are recorded only in financial book. They are not recorded in cost book. By recording items of provisions, profit of financial book goes down and profit of cost book remains up. notional expenses, notional incomes not recorded in financial book. In cost book they are recorded. Now what is notional expenses and incomes? Whatever expenses we are actually paying, that we record in financial book. For example, office overheads paid or outstanding will be recording in financial book. Those expenses which are accrued are also recorded. Those expenses are payable or actually paid, those will be recorded in financial book. In cost book we record certain expenses which we are not going to pay in cash. That means they are not payable and not actually paid. Those are recorded on notional basis. For example, notional salary to proprietor. When proprietor is working for his own business, he don't get any salary, and in books of accounts we can't show salary paid to proprietor in financial book. In cost book we record that salary on a notional basis to arrive at correct cost amount. Therefore it is recorded in cost book but it is not recorded in financial book. Notional rent of office owned. If we take office on rent basis, we are required to pay office rent. But same office, if it is owned by the business, we are not required to pay any rent. Therefore in financial book we don't record any rent item. But in cost book, to arrive at correct amount of profit, we record office rent on notional basis. Because of recording notional expenses or incomes, there will be difference in profit as per financial book and cost book. Continue. If there are pure financial expenses, for example, interest on loan, cash discounts, these are recorded in financial book. In cost book these are not recorded. By recording financial books only in financial book, it brings down profit of financial book in relation to cost book. Over recovery or under recovery of overheads. For example, as per financial book, factory overheads are 10,000. As per cost book, factory overheads 8,000. So actual amount is paid 10,000 in financial book, but cost book shows factory overhead should be 8,000. This is called as situation of under recovery of overheads. Selling overheads as per financial book 20,000. As per cost book it is 25,000. So selling overheads are more as per cost book. This is called as situation of over recovery of overheads. Sometimes there is use of term over absorption and under absorption of expenses. Overvaluation and undervaluation of stock. There is possibility that stock may be valued at different figure in both the big books of accounts, which may give rise to problem of difference in profit as per financial book and cost book. So these are the numerous reasons due to which there will be difference of profit as per financial book and cost book. We are required to reconcile them by preparation of statement, which is called as profit reconciliation statement. Let us understand the format of profit reconciliation statement. Profit reconciliation statement is prepared like bank reconciliation statement. You have to start with profit as per one book, for example profit as per financial book, then you will end with profit as per cost book. Meanwhile, we are required to add as well as subtract certain items. These are the items which are responsible for difference in profit as per both the books. So these are the items we may require to add or we may require to subtract. Profit as per financial book, you may also start with loss as per financial book, and finally you will arrive at loss or profit as per cost book. Other way is you will start with profit or loss as per cost book, if we start profit as per cost book, we'll end up with profit as per financial book. It may be loss as per cost book, it will end with profit or loss as per financial book. All the items which are having plus sign, positive numbers, will take total of this and that will be added to opening balance, that is profit as per financial book in this case. You take total here and these are the negative amounts. This total will be subtracted to arrive at profit as per cost book. Here in this format, positive numbers will be added. It will be added to opening balance. We'll arrive at total. These are the negative numbers. We'll take total of it and we'll subtract that from this total. Finally, we'll arrive at profit or loss as per financial book. The main question now remains how to decide which items to be added and which items to be subtracted. For that purpose, we are required to use a simple technique by preparing working note. How to prepare a working note? It's very simple. We'll be recording the amounts which are different in both the books, whether it is expense or it is item of income. We are required to be careful while fixing the columns. Profit reconciliation statement is starting with financial book. Means first we have financial book, then first column will be financial book. If we are starting with profit reconciliation statement as per cost book profit, if starting point is cost book profit, then our first column will be cost book, second will be financial book. Here we have assumed that we are starting our profit reconciliation statement with profit as per financial book. Therefore, first column is financial book and the second column we have kept cost book. Now, various items of incomes and expenses, let us consider. Administration overheads. Say for example, in financial book it is given 20,000. In cost book it is given 25,000. Direct material as per financial book 1 lakh, as per cost book 95,000. Direct labor as per financial book 50,000, as per cost book 60,000. Selling overheads as per financial book 75,000, as per cost book 70,000. Loss on sale of investment. Goodwill written off. Opening stock, it may be of raw material, work in progress, finished goods, anything. Similarly, we will be recording incomes, sales, as per financial book 7 lakh, as per cost book 6 lakh 90,000. Closing stock, it has got effect of income but it is because it is recorded to the credit of income statement. It may be closing stock of raw material, work in progress, finished goods. As per financial book 40,000, as per cost book 50,000. Dividend received 10,000. Profit on sale of asset 5,000. So there may be variety of expenses and incomes which we are required to record like this. Now listen carefully, we are required to deduct amounts of second column from amounts given in first column. Like administration overhead, first column 20,000 minus 25,000. So answer will be minus 5,000. Now this minus 5,000 in our profit reconciliation statement, it will fall in this less items. If we prepare profit reconciliation statement by taking any profit as a starting point, if in working note if we are getting it is minus amount, it will be recorded here in less portion of profit reconciliation statement. Direct material 1 lakh minus 95,000, it is plus 5,000. This plus 5,000 here it will be recorded in plus portion. Direct labor 50,000 minus 60,000 minus 10,000. Selling overhead 75,000 minus 70,000 plus 5,000. Loss on sale of investment, it is there only in financial book. 5,000 minus 0, so it will be plus 5,000. Goodwill written off 6,000 minus 0. This is an item only recorded in financial book, plus 6,000. Opening stock, it is recorded along with expenses on debit side of income statement, so it has got effect of expense. 60,000 minus 40,000, it will be plus 20,000. So in case of expenses, whatever actual signs we are getting, if we are getting plus in profit reconciliation statement, we have to add. If we get minus in profit reconciliation statement, we are required to subtract that amount. In case of incomes, we are required to reverse the sign. For example, sales 7 lakh minus 6 lakh 90,000. You get here plus 10,000. But in profit reconciliation statement, you are required to take opposite sign. That means you are required to take minus. Closing stock 40,000, 50,000. It comes minus 10,000. In profit reconciliation statement, we are required to take it plus. Dividend received 10,000 minus 0, it will be plus 10,000. In profit reconciliation statement, we are required to take minus. Profit on sale of asset 5,000 minus 0, it will be plus 5,000. In profit reconciliation statement, we are required to take minus. Whether we'll make our profit reconciliation statement correct or not, it all depends on how we obtain signs in this last column. It hardly takes few minutes to construct this last column. Once we got these plus minus signs, plus and minus signs, we are required to use them to prepare our profit reconciliation statement. Thanks for watching this video. Stay in tune with Ekeeda and subscribe to our channel Ekeeda